All right, let's dive into one of the most powerful, yet, let's be honest, most underestimated forces in all of finance. We're not talking about quick wins or chasing the next hot trend. No. We're talking about the incredible power of playing the long game.
So just for a moment, forget all the noise, the frantic day trading, the stock tips you hear from your cousin. We're going to explore a strategy that's way less about clicking buttons and way more about a fundamental shift in how you think. And it all really boils down to this one question. Is the secret to wealth about timing the market, or is it about mastering what's going on inside your own head?
So, our journey starts with the most fundamental distinction in investing. Seriously. Because where you put your focus, on the ticker price flashing on the screen, or on the real value of what you're buying, well, that can make all the difference. And this, right here, lays it out perfectly. You've got two different players in the market. The investor, they're looking at the business, its actual health, its long-term value. But the speculator, they're just obsessed with one thing, the price, that daily up and down wiggle of the stock. See, one person is buying a piece of a company, the other is basically just betting on a number. They are playing two completely different games. And who better to sum this all up than the man himself, Warren Buffett? This quote just nails it. The price? That's just a number. It's what the market is feeling today. The value, though, that's what you actually get. That's the real tangible worth of the thing you're buying. This entire way of thinking actually has a name. It's called value investing, and it was pioneered by the legend Benjamin Graham. And the goal is pretty simple when you think about it. First, you figure out what a company is actually worth, what Graham called its intrinsic value. Then, you just wait. You wait patiently until the market, in one of its classic moody swings, offers to sell it to you for way less. That gap, that discount, that's your margin of safety. It's your built-in cushion just in case you're a little bit wrong. Okay, so once you've got that value-first mindset locked in, you get to unlock what some people have called the most powerful force in the entire universe. Let's see how this thing works. And here's the best part. You don't have to be some kind of Wall Street genius to make this happen. You just need to understand how time and patience work together to grow your money from a tiny little flake into a giant snowball of wealth. And this is the magic right here. It's called compounding. It's a simple little four-step loop. First, you invest. Then, your money earns some returns. Now, here's the key. Instead of cashing out, you reinvest those returns. And that's when things get interesting, because now your returns start earning their own returns. It's a cycle that kind of starts slow, sure, but over time, it just explodes. So, just how powerful is this in the real world? Well, check this out. Research has shown that if you consistently reinvest your dividends, you don't just get a little extra boost. Over the long haul, it can more than double your total returns. I mean, think about that. That's the difference between a little snowball you can hold in your hand and a full-blown avalanche roaring down the mountain. Okay, so the theory sounds great, right? The math makes sense. But what does the hard data say? Does this whole patient, long-term thing actually work out in the real world? Well, let's look at the evidence. An economist named Jeremy Siegel did this absolutely incredible study. He looked back at over 200 years of financial market history, and what he found? Well, it's just staggering. Now, what's so fascinating here is that when you first look at it, the difference doesn't seem, that crazy. From 1801 all the way to 2021, stocks gave an average real return of about 6.9% a year. And nice, safe, long-term bonds, they returned 3.6%. So a difference of just over 3%. Doesn't sound like much, does it? But remember that snowball effect? Okay, let's see what compounding does with that seemingly tiny difference. So let's start with bonds. If you invested just one single dollar back in 1801, by 2021, it would have grown to over $2,000. Hey, not bad. That's a solid, respectable return. But what about stocks? And here it is. This is the power we have been talking about. That same $1, if you'd put it in stocks, would have grown to over $2 million. No, that's not a typo. That tiny little difference in the annual return, when it's compounded over 2 centuries, created a truly life-altering, monumental amount of wealth. So, if the math is so clear and the history is so decisive, why doesn't everybody just do this? Well, it turns out the biggest roadblock isn't in the market. It's right between your ears. Yeah, the problem is our brains just aren't wired for this stuff. We're wired for short-term survival. Run from the lion, find the next berry bush. We are absolutely not built to patiently compound wealth over decades. We're driven by these powerful psychological biases that are constantly whispering in our ear, tempting us to do the exact wrong thing at the exact wrong time. And here are the usual suspects. You've got loss aversion. That's the one where the pain of losing $100 feels way worse than the joy of gaining $100 and it makes us panic sell. Then you've got herd behavior and its cousin FOMO, the fear of missing out. That's what makes us all pile into a hot stock right when it's at its peak. And of course, good old overconfidence, which convinces us that we're the one genius who can outsmart everybody. These instincts, they are the mortal enemies of patience.
So it really just comes down to these two paths, right? You can follow the path of market emotion, where you react with panic and euphoria, which, let's be real, almost always leads to that classic mistake of buying high and selling low. Or you can choose the path of investor discipline, responding with cool analysis and patience, which lets you actually stick to your plan and build that value over the long term.
All right, we've talked about the philosophy, the math, the history, and the psychology. So now, let's bring it all home and look at a really tangible, real-world reward you get for having this kind of long-term discipline.
Because it's not just about the incredible returns from compounding. In many places, a patient approach is actually rewarded by the system itself. It's not just a good idea, it's a financially smarter one.
I mean, just take a look at this example from the Brazilian tax code. The system is literally designed to reward you for being patient. If you're a long-term investor, you pay a lower tax rate on your gains, 15% compared to 20% for a day trader. And check this out. You can get a tax-free allowance on sales up to 20,000 reais a month. And the day traders? Nope, not applicable. They get nothing. The rules themselves are telling you, hold on for the long run.
So let's wrap this all up. What is your long-term advantage? Well, it's built on a rational foundation. You focus on value, not price. It's powered by an unstoppable mathematical engine. You let compounding do the heavy lifting. It's backed up by historical proof. You can trust 2 centuries of hard data. It demands a psychological shield, using discipline to beat your own biases. And, as we just saw, it can even come with a direct financial reward like better tax efficiency.
Look, in the end, the evidence is pretty overwhelming and the logic is just solid. The path to building real, long-term wealth isn't some kind of hidden secret. It's a discipline. The strategy is proven. The only real question left is, are you patient enough?